I think we're into right now. We're just in a short-term correction in a much larger bull market. Well, the overall market, depends on what market you want to talk about. Like the U.S. market is really the key market on the planet, and it's been on fire for the last couple of years. Everyone knows that. So, but it's now rolling over in my view. I think we're likely going to see, a fairly large decline in the stock market sometime later this year, and that could bring all stocks down, even the mining stocks. But if you go back and look at what happened in 2002, 2003, and also in 2008, 2009, the first sectors that actually moved were the mining stocks, and they have over the decades have always proven to be really, the place to be to keep your wealth somewhat intact, and it's worked for me for 35 years. But you have to be nimble. You have to trade these stocks, and you and I have spoken about this before. If you're up 300-400% or 500% on a stock, you should be selling half of it and waiting for that decline, because the mining sector is cyclical, the stock market is cyclical. And you've heard from Rick Rule many times, and myself, that you need to have a 10-year view on investing in resource stocks, because that's how long these bull markets last. This bull market started, let's call it January 2016 for whatever, you could call it December 2015 if you wish. But going out 10 years from that point, you're in 2025. And that's kind of the time frame that I'm looking at. So, I wouldn't be looking at this time to be liquidating. I'd be looking at opportunities to be buying high. And that's the kind of market I think we're going into. And that's when the miners and the metals just exploded. And we saw silver go from $5 to $50. We saw gold go from $250 to $1,800. We saw copper go from 60 cents to $4. We saw uranium move up to $140. We saw oil go up to $140. We saw real estate prices take off. There was this huge inflation trade. And it started off as really an asset trade, because the market, the big institutions, the big money out there realized, hey, we've been buying crap. All we've been buying is business plans without any backing, like SPACs, for example. So they just got tired of it, and then they blew all this stuff out, driving the Nasdaq down, as I said, by 80%. And all that money flowed into real assets, real estate, oil, copper, silver, gold, and mining stocks, and so on. And I think we're halfway into this, and we've got a long ways to go yet. That there's nothing different between the bear market from 97, call it, to 2001, but the bull market started in 2002, and it lasted until 2012, 10 years. But over that 10-year period, there was many corrections. There were several times over that 10-year period that the executives in the mining sector thought the bull market was over, but it wasn't. It just it corrected for 6 months, and sometimes gut-wrenching corrections, and then boom, it took off again. And that's the kind of thing that but as I said, investors who invest in this space, this is a very risky, very cyclical, very volatile space, and you never know when the bull market's going to end. Despite my view that we're, 10 years, it's going to be a 10-year long bull market. I could be wrong. So in that case, you have to take advantage of, movements. If you're, buy a 50-cent stock, and next thing you know, it's $3. And that's happened many times to you, I know, Jake, and it happens to me as well. And then when it does, you just have to be disciplined. You sell part of your position, despite your views. You may think the stock's going to go to $10, but you have to be prudent. Take your money off the table, even take a little bit of profit off the table. Take your position down by 50% or 75% and wait for that correction. If it doesn't correct and the stock keeps going and you sell your balance at some other higher price, so be it. You made a lot of money, and then go on to the next company. Just don't fall in love with your investments. And always, when you buy, pick your price and that you're willing to pay for it. And also, as you're buying, visualize the price that you want to sell it at. And a lot of people don't do that. And if you do that and remain disciplined, you'll find that you do quite well over time. Most people are not good sellers. Selling is the hardest thing to do. We're not trained to sell. We're trained to buy. We have credit cards quite young. Where we liked having toys, we liked having stuff, right? So we're always looking to buy things. When we turn around and sell something, we often just give it away because you don't have the energy to sell it. Silver is a very, very tiny market, and that's why I'm so bullish on silver, is because some of these other metals like copper, that's a pretty big market. But silver, there's only 2020 numbers, we don't know exactly what they are yet, but we think there was about 750 million ounces of silver produced in 2020 worldwide. That's down now 4 consecutive years from a peak of 880 million ounces that was hit or reached in 2015, I believe. So, 4 consecutive years of declines, and demand is increasing, and that falls off going backwards. So we're getting tighter and tighter and tighter in this very, very tiny market. Less than what's 800 million times $25. You're in a $23 billion market. How many times can that market fit into Apple? So it doesn't take much to move a market like silver. Unfortunately, it's very paper driven, and there's a lot of derivatives out there. But and that's what this whole Reddit movement is all about buying physical. And I'm coming to the belief now that it may not be the industrial demand that actually drives price for $100 an ounce. It actually may be the retail demand that just understands the importance of this metal. In fact, it is such a strategic metal, and it's necessary for everything that we do as human race, and people just want to own it. Because the banks are able to manage the market. Like they know the supply that's coming. They've got, we have, like the people we use to market or not market, but sell our metal, they have a pretty good idea of, what we're going to produce in 2021. We put out guidance in January, and we update our guidance in July, and the entire mining sector does the same thing. So the banks kind of know what's coming in the door. So they know what the price should. So if Sony phones up and says, hey, we need, 50 million ounces of silver delivered at these variety of ports around the world for the production of our products, JP Morgan or HSBC kind of know how to price it, right? So they'll give them a 12-month price. So they're taking a short position on that trade. And of course, Sony's expecting the delivery of this metal over the next 12 months. So it's now in the best interest of the banks to keep the market within a fairly tight range, because they don't want that trade, to cost them very much. So, they've got a pretty good handle on the supply-demand fundamentals of these markets.